Good afternoon. Good afternoon, everybody, and welcome. My name is Steve Jewell with Community Giving, and we are delighted to have you join us today for what we think is going to be a wonderful educational webinar featuring a fantastic speaker. We're going to give people a chance just to get into the room here, and in the process, I will also go through a few housekeeping things. First of all, this webinar is being recorded so that if for some reason you need to step away, we will be emailing it out, so you'll be able to watch it in its entirety afterwards. But for those of you who are here, we're really grateful that you took time out of your day to be with us. Also, we will be having a specific time for Q&As, but if you do have questions as we're going, please put them in the Q&A tab, and then we'll have them there for when we get into the Q&A section of the webinar. So without further ado, I think we're going to get started. I'd like to introduce Meredith St. Pierre, who is the Executive Director of the Greater White Bear Lake Area Community Foundation. Meredith.
Hi, yes, thank you. As Steve said, I'm the Executive Director here in White Bear Lake. We serve the 7 communities that touch the shores of White Bear Lake. If you're from here, you're going to wonder what they are, because there aren't really 7 on the lake, but they're there. We are a partner foundation of Community Giving, and I have the pleasure today of introducing Joe Thiggs. I was lucky enough to meet him earlier this week at the MPGA conference, and perhaps there's some of you others on the call that were with us at the MIA over the last 2 days, the learning continues today. Joe is the president and owner of General Works, a national consulting firm based in Minneapolis, Minnesota, serving a variety of clients, specializing in plan giving and family philanthropic advising. He made consulting a full-time job in 2019. Before that, Joe was the plan giving director at Minnesota Public Radio, American Public Media in St. Paul. And before that, he worked as the associate director of advancement at the University of Minnesota Law School and as a plan giving officer for the University of Minnesota Foundation. And I guess before philanthropy, he dabbled in and will continue to share his knowledge. He was an estate planning attorney at Dorsey Whitney in Minneapolis. He got his BA at Northwestern before coming here to Minnesota for law school. And he's been here with us in Minnesota ever since, and we're very lucky to have him and his expertise. Joe, thank you for joining us today to help us understand how the One Big Beautiful Bill affects charitable giving, estate planning, and corporate philanthropy.
Thanks so much, Meredith. And I was lucky enough to meet you earlier this week. And I want to say thank you to Steve and Dominic and Meredith and Sarah, everyone else here at Community Giving for inviting me to speak today and to share a little bit and hopefully have some fun too. And I wanted to say before we jump into the slides, which actually maybe I'll share my screen in just a moment, to give a couple of prefatory notes. And the first of those is to say thank you to all of you who are here as attendees. I know that the most precious limited commodity that we have these days is our time, and the fact that you are taking some of that precious time to be here on this webinar to hear and talk about something that's near and dear to my heart, but hopefully is meaningful to you too. That's meaningful and special, and I am grateful to be able to share this space with you. So thank you for that. Secondly, I want to just acknowledge that there's a lot of information here that's presented in a relatively short span of time, and so that there's no expectation that any one person retains even a significant portion of what's here. Hopefully you'll have the materials afterward that you can refer back to if you want, but I do have a goal, and that goal is that I hope that every person who is here today will find one new thing. Maybe it's one new idea, one new thing learned, one new perspective or way of looking or thinking about something a little differently than you did before. That will be helpful either to you personally or to someone you care about or your organization. And if we can say we've achieved that, I will count that as a win. So that said, I want to offer the disclaimer that I am sharing information here that is correct to the best of my knowledge, and if I notice something that's a little off, I'll point it out. I would appreciate if you notice something that doesn't look right, if you would let me know so I can improve these materials going forward, but also to note that I do not provide legal, accounting, or tax advice. And so to the extent that you want to confirm anything, please consult with your own professional legal, accounting, or tax advisors, some of whom may be on this call. So thank you. And with that, we will turn to the presentation. So smart giving and shifting times, tax-wise strategies for charitable impact in 2025 and beyond. Just a little, I jumped ahead, a little bit of a roadmap here of where we're going. The introduction is what we're doing right now. Changes under the One Big Beautiful Bill Act, we'll review some of those provisions and how they might affect charitable giving. Then we'll spend a little bit of time talking about using appreciated assets to maximize benefits with charitable giving. Then we'll turn to a few thoughts and observations about planning for the end of this year and also for 2026 and beyond. And then we should have some time at the end for Q&A as well. So before I jump into the substantive slides, I want to take a step back and ask everybody to think a little bit about the why. So a lot of what we spend time doing as professionals is about the how and the what, the tools and techniques and how this works and how that might be applied. But I want to make it clear that it's important to think also about what we're trying to accomplish. What's your why? What's your reason for being here today? And if you give to charities, why are you here today? And for me, this slide right here represents some of my why. So these are my three kids on our front steps almost exactly 15 years ago. And of course, they've grown up a bit since then. The young man on the left is now an engineer at Boston Scientific, developing treatments for atrial fibrillation, and the young woman on the right is now a junior at Gustavus Adolphus College, and the young lady in the middle is a senior in high school, trying to decide what to do next year and applying to colleges and the like. So this represents the why for me. Why I get up in the morning, why I work hard and to try to provide for them and also for my wife and for me in the way that we want to care for our family and also take care of our community. The organizations and missions and causes that have been important to us in our lives, we want to make sure that they're taken care of as well as our family, as part of our legacy. So this is an updated picture, just a quick family selfie that we took about a week and a half ago. So the time flies, I guess. All right, the One Big Beautiful Bill Act, sometimes abbreviated as OB3 or OBBBA. What does it mean for charitable giving? So there are several parts of OB3 that made permanent some provisions of the Tax Cuts and Jobs Act of 2017 that were set to expire at the end of this year, on December 31st. Some of those include lower ordinary income tax rates, the top rate now being 37%. That is now made permanent, or when I say permanent, I mean as permanent as anything with Congress. A later Congress and president could decide to change that if they wanted to, but at least as far as we can see, there's no sunset for these provisions. It's going to be that way for as long as we can tell. So rather than having it go back to a top income tax rate of 39.6%, it stays at 37%, as well as other adjustments to the other tax brackets. The increased standard deduction, as you may recall, Tax Cuts and Jobs Act in 2017 doubled the standard deduction. That now is a higher level permanently going forward, and it actually bumped it up even further to $15,750 for single filers and $31,500 for joint filers this year in 2025. Additionally, there's an inflation adjustment now, and I think the inflation adjusted number for next year is $32,200 for married filing jointly. It made permanent the suspension of some personal exemptions. If you were doing taxes prior to 2017, you might recall that you'd get personal exemptions for yourself and other dependents. Those are no longer an option, and there is an increased child tax credit that is now permanent. It made permanent the pass-through business deduction for Section 199A for certain businesses that might be a single-member LLC or a partnership, or it passes through income for qualified small businesses. That now is part of the law indefinitely. Tighter limits on certain itemized deductions like mortgage interest on home loans, and then probably most notably for estate planning purposes, higher federal and estate tax exemptions. So those higher transfer tax exemptions, as you may recall, were doubled by the Tax Cuts and Jobs Act. It was $5 million indexed for inflation, and then became $10 million indexed for inflation. So that's where we got to where we are now, and now that is being raised even further to $15 million per person, or $30 million per married couple as of next year, and indexed for inflation going forward. Okay. So just to take a look and say a couple of words about federal estate and gift taxes. We're not going to talk a ton about them, but a few things to note. This year in 2025, the estate tax and gift tax exemption combined, the unified, is what I used to call it, transfer tax exemption is $13.99 million per person, or $27.98, just shy of $28 million per married couple. And again, this goes back to what used to be the $10 million indexed for inflation. About a year ago, in fact, almost exactly a year ago, conventional wisdom was that because the law from 2017 was set to expire on December 31st of this year, of 2025, back before the elections last year, most commentators were predicting that the gift tax exemption would end up lapsing or going back to a lower level, basically dropping back to that $5 million index for inflation, which at the time, which now would be about $7 million per person, or $14 million per couple. So there was a lot of discussion about what should happen in planning in light of that. When the elections happened, and rather than one house of Congress being controlled by each party, we now have both houses of Congress controlled, and the presidency controlled by the Republicans, and the conventional wisdom flipped very quickly to assume or expect that those higher exemption levels would remain because of that. And that is indeed what happened with the One Big Beautiful Bill Act. We can see that those exemptions now are at $15 million in 2026, and then $30 million for a married couple in 2026, and then indexed for inflation going forward. So that's where we are these days. That means that fewer and fewer people will be worried about transfer taxes. That said, there are many people who do have estates of that size, and we need to be prepared to help them when needed. So another thing to note about this is that the annual gift tax exclusion is $19,000 this year. I believe I saw in the inflation adjustments for next year that from the IRS that came out not too long ago that it's staying $19,000 for 2026 as well. For those of you who may not be aware, the estate and gift tax exemption is the amount that you can pass free of estate and gift taxes to individuals without having to pay estate and gift taxes. And that's for lifetime gifts made during life, as well as gifts transferred at death. The annual gift tax exclusion is the amount that you can give to as many people as you want without having to use up any of your estate and gift tax exemption. So, for example, if I had the money on me, I could give $19,000 to everybody who's on this webinar. Well, wouldn't that be nice? But if I gave $19,001 to anybody, I would have to file a gift tax return, or theoretically I should be filing a gift tax return, reporting 19,001 gifts, 19,000 of that is covered by the exemption, so $1 of taxable gift. Now, I wouldn't actually pay gift tax on that because I just use up $1 of my lifetime exemption. So now instead of $13,990,000, I have 13 million. Oh, I should have done this ahead of time. $13,989,999 of exemption. I believe that's how it would work out. But let's say you do use up all of that lifetime and estate tax exemption, and you have to pay some gift and estate tax. The rate for that tax is 40 cents. So of every dollar that you would send to an individual, 60 cents would go to them, 40 cents would go to Uncle Sam. Now, there's another layer here, and that is that a number of states, Minnesota being one of them, has their own separate estate tax, a standalone estate tax. And Minnesota's estate tax exemption level is lower than that federal level of just under 14 million, going up to 15 million. Minnesota's exemption level is $3 million per person. So that means that you can give up to $3 million to individuals without having to worry about Minnesota estate taxes. But if you give more than that, then you will end up having to pay some Minnesota estate tax, which is a lower rate than the federal. So Minnesota estate tax starts at, it's a graduated rate, so it starts at 13% and going up to 16% for the largest estates. If you're a married couple, you can do some planning through a technique called a a credit shelter trust, which would be a way to use both spouses' exemption amounts, the $3 million Minnesota estate tax exemption. You can do that at the federal level too, but there's a provision that can automatically use both spouses' exemption at the federal level called portability that doesn't exist in Minnesota. So you really have to do some planning if you want to transfer more than $3 million to individuals and you are a Minnesota resident. In addition to those permanent changes, the One Big Beautiful Bill Act also made several temporary changes that have to do with individual income tax. And some of those I'm sure you've heard about. It's the new deductions for overtime and tip income. You know, some people were talking about this as no tip income tax or no overtime. That's not quite accurate because these are limited in scope. There are some parameters to them that don't make it completely unlimited, but there is a new deduction for a certain amount of overtime, a certain amount of tip income if it's reported in a certain way. And there's also the new $6,000 or up to $6,000 deduction for seniors age 65 and older. That is phased out at a kind of a surprisingly lower level of income than I would have expected. So that starts to phase out at $75,000 for a single senior, or $150,000 for a married senior couple, and then completely goes away around $150,000, I believe, for a single person, and about $250,000 for married filing jointly. But that is a new deduction that's available for seniors who have incomes below those levels, and then phased out as they're in that range. There's also an increased deduction limit for state and local taxes. That's meaningful for people who are here in Minnesota, where we do have an income tax. It doesn't matter as much for those folks who live in states without income taxes, but for those of us who do have state income taxes, that's a big deal. So the limit before was $10,000 per year under the Tax Cuts and Jobs Act. I believe prior to that it was not limited, but then maybe there are some limits that I'm not thinking of, but I never hit that limit anyway. and the Tax Cuts and Jobs Act imposed this $10,000 limit for SALT. Now, because of some negotiations with lawmakers from states with income taxes, that's been temporarily raised to $40,000 until 2029, but there is a phase out there for higher income taxpayers in the $500,000 to $600,000 AGI range, I believe. And that's something that will allow more Minnesotans to itemize than could itemize before. Additionally, there's a new deduction of up to $10,000 for interest paid on auto loans for cars assembled in the U.S., but then that starts to phase out for people with income of $100,000 if you're single, or $200,000 married filing jointly. That runs for 4 years as well, from 2026 through 2028. Some notable changes related to charitable deductions. So this is a big deal for those of us who operate in the nonprofit world. And the first of those is a haircut or a reduction for charitable deductions for donors who are in the highest income tax bracket. So this really only affects those people who are in the 37% bracket, less than 1% of filers. But for those who are in that bracket, it may make a difference. This is for people with taxable incomes over about $626,000 if they're single, or about $750,000 for joint filers this year. But those brackets will be adjusted for 2026. And just to keep in mind, this only goes into effect starting in 2026. So I didn't mean to imply that this starts 2025. This is something that's new as of 2026. How it works is it reduces the charitable deduction by a nice even fraction, 2/37 of the lesser of either the amount of the charitable deductions or the amount of income taxed at that highest rate for those taxpayers. The practical upshot of that is that it limits the deduction to 35% savings. Or another way of looking at it is that the effect is the loss of 2 cents of tax savings per dollar for those people who are in the highest tax brackets. Basically, you will not save more than 35 cents per dollar going forward starting in 2026. There also is a newly imposed floor for itemized charitable deductions. This is a significant development starting next year. Only the amount of charitable gifts that are above 0.5% of the donor's contribution base, and that's a defined term, but for most people it's going to mean AGI. It's AGI with certain adjustments, but for most people it's going to be their AGI. So basically, still am visible to all of you. And let me see if I can get back to seeing anything on my screen. Could one of the folks from community giving let me know if you can still hear me or see me at all?
Hey, Joe, we can see you and we can see your screen.
You can see the screen, okay, but I can't see the screen. So fortunately, I have a backup plan, which is like printed paper. So what I'm going to do is I'm going to continue to forward, and I'm just going to look at my own slides here, and then I will do my best to advance the slides at the same time here. So let me. Okay, I don't want to click anything that will change the slides before I want to. Okay.
We'll help keep you on track, Joe. If
you
need to know what slide is what, we can help you out.
I appreciate that. Thank you. All right. So I'm also going to put on my reading glasses because I'm at that time of life when I need those. Okay. So hopefully we are on the piece where. Okay. Are we still on the 37%, or we're in the floor for charitable deductions? So the 0.5% floor basically means that for someone who has an AGI of 200,000, for example, 0.5% of that is $1,000. They won't be able to count the first $1,000 of their charitable deduction. Similarly, there's also a 1% floor of, I think, taxable income for corporate gifts, and a 10% cap on the amount that can be deducted in any year for corporations. So that could have some effects on corporate giving, as well as make it less attractive for smaller gifts or itemizable gifts from individuals. Okay, I'm going to try to advance this and let me know if this works. Did the slide go?
No.
Okay. How about now?
We're still on the.
Okay.
We're still on slide 12.
Okay. Any change now?
Still no.
Okay. All right. Let's see. If we go to, okay, let me just see.
Joe, do you want to try stop sharing your screen and then starting it again? That might work.
I would like to, accept. I have a dead screen. I can't see anything at all. So I think I would need someone to stop it for me. And then if one of the community giving folks would be able to pull up a PDF of the materials, we could do it that way. Apologies for the technical difficulties.
We're communicating behind the scenes here. So
okay.
Hold on.
Great.
So Joel, while we're trying to get these the technical things settled, there's just a dizzying array of stuff that you've already talked about, and I'm sure you're going to talk about more. So generally speaking, if you look at this from like a really high altitude, what sorts of, and if maybe the answer is lots, but who do you see? What kind of donors? What kind of organizations do you see being the most affected by all of these changes, or which one of them are going to have the most impact?
Well, honestly, I think the biggest impact is probably, and this wasn't queued up in advance, but I think the biggest impact probably is going to be for charities that have donor advised funds. And this, I don't want to give away too much of the thunder for later in the presentation, but having to do with gifts to DAF via bunching.
Great. Can you see the screen? It looks like we've got Steve's screen up now, and it looks like we are on the 60% AGI deduction limit. Can you see that?
I'm flying blind. Literally my screen is black.
Okay, so the slide that we're looking at says OBDA changes to charitable deductions. The first bullet item is 60% AGI deduction limit for cash contributions. So that's
great. Great, okay. Thank you. All right, thank you for for coming to the rescue. Good. Okay, so this is another change, the charitable deductions. As you may recall, that there used to be a limit of 50% of AGI for deducting cash gifts, and the Tax Cuts and Jobs Act increased that temporarily to 60%, so you could deduct up to 60% of your adjusted gross income for cash gifts made. This One Big Beautiful Bill Act made that permanent. It did not change the AGI limit for long-term capital gain property. That still stays at 30%. There's also a new charitable deduction for non-itemizers, and I think this is going to be something that could be very meaningful for a lot of folks too, and that is starting next year, so starting as of January 1st of 2026, non-itemizers also are able to deduct charitable gifts of up to $1,000 if you're a single filer, or up to $2,000 if you're married filing jointly. So I see that being a nice benefit in a couple of different ways. So you may be aware that in recent years, about 90% of people take the standard deduction. 85 to 90% of people take the standard deduction, and about 10 to 15% or so are itemizers. It used to be that about a third of people would itemize and 2/3 would take the standard deduction, but when the standard deductions doubled, then understandably fewer people are itemizing. Now more are just taking standard deduction because their total itemized gifts don't come up to that threshold, and so this is a nice way for those 90% of people who aren't actually getting a tax benefit, for most of them at least, from their charitable giving, to realize some tax benefit from smaller cash gifts of up to $1,000 per person or $2,000 per couple. These cannot be made to donor advised funds, so that's something to note. This is, you might remember back in the pandemic, there was enacted a temporary provision just for a couple of years that allowed smaller cash gifts of up to $300 per person, or ultimately $600 per couple, to be taken as like an above the line deduction. This is similar to that. Although I've been informed that this, technically the way it's going to work on the return, it's not actually about an above the line deduction. It comes below the line as a special deduction, so it doesn't actually reduce your AGI. Okay. Next slide, please. So what does this mean? It was said that for those 85 to 90% of people who are taking the standard deduction, this gives them a new incentive to make gifts to charities that they maybe didn't have before. So I think that's something that could be marketed by nonprofits to do some year-end messaging about this opportunity. Oh, I'm sorry, I take that back, because it's for 2026. So maybe they want to start marketing it for 2026 as a new opportunity. But I think it is really going to be meaningful for the years that it's effective. Also, the reductions, or that AGI floor of 0.5% for individuals and for 1% for corporations, I think that's going to have a negative effect to some extent, especially with the corporate gifts, where there are a lot of companies that might fewer of those smaller gifts if they're not going to be able to deduct them. Now, maybe some companies will still want to support places in their community anyway, but it's a little bit of a disincentive to that. And then also the highest income donors, that they have a reduced tax benefit due to that new 35% savings limit, where before they could have gotten up to 37% savings. How much of a difference is that going to make remains to be seen. For many donors, they may decide that it doesn't make a big difference for them in the end. Next slide, please. So some more takeaways: that the higher gift and estate tax exemption amounts, that they reduce to some extent some tax incentives to leave estate gifts to charity compared to what the law would have been for donors who have estates, I'd say, between roughly 7 million and 15 million, or if you're a married couple, between about 14 million and 30 million. Some plans are set up that they leave as much as they can leave without having to pay estate taxes to family members. And for amounts above that, they would avoid estate taxes by giving the excess to charity. Well, now that threshold's higher, they can leave more to the family members. Maybe some charities get a little bit less as a result of that. But really, at the end of the day, time will tell. It's a little uncertain about what the overall effect is going to be, as some of these changes might be considered fairly minor and aren't going to be the tail that wags the dog with respect to charitable giving. And oh my goodness, my computer seems to be coming back online. It was Zoom that crashed apparently. So now it is back. So I guess we can keep it. Oh, okay. I'll share my screen. That's good. All right. Go back here. I will share. I will put it back in the presentation mode. Hopefully we'll get to that soon. Oh, you know what? I think I need to stop sharing, put it in that mode beforehand, and then go back to it.
And I will take this opportunity while Joe is doing his tech thing to say, if you do have questions, we will take questions through the Q&A tab down at the bottom of your Zoom screen. If you just click on that tab, that'll send a question to us. We will triage those questions, and we will present them to Joe when he gets done with his conversation. So don't hesitate. Don't wait. If you got a question, you're not going to mess with anything if you start putting in questions now. So as they come up, feel free to raise your questions. And Joe, it looks like you're back online.
Great. Thanks, Dominic. Okay, so yes, it looks like we caught up here. So I would say the last takeaway or point here is to talk with your donors and consider, especially for those people who might have been contemplating a major gift next year. Maybe they should think about accelerating that into 2025 so they get a better tax benefit from that, especially if they're a high income donor and they're in that 37% income bracket. They're going to get more that way, and they'll also avoid that AGI floor that they're going to encounter if they wait till 2026 for that. So start talking with your donors now, and if they might be able to be in a position to make that gift in 2025 before year end, they're going to have more tax savings, generally speaking. Okay. Now to switch to the next topic, which is charitable gifts of appreciated assets. Now, I'm sure most of you have heard many times before that appreciated assets are often very good things to use for making gifts to charity, but it can't hurt to review if you've heard it before, and if you're hearing it for the first time, it will explain why. Before I get into calculations about anything, I want to talk about the importance and value of considering non-cash assets generally. So if you think about your own situation, I'd be willing to bet that cash and cash equivalents, so checking account, savings account, probably make up a fairly small percentage of your overall assets. I know that's true for me and my family. It's true for most of us. And in fact, I've heard varying statistics. I've heard numbers as low as 2%. I've heard numbers as high as 9%, but it's probably somewhere in the single digits as far as how much wealth is held in cash and cash equivalents. And most people at the same time, when they're making charitable gifts, they're really only thinking about what's in their checking account or savings account, or maybe make a gift on a credit card that they're later going to have to pay with a checking account or savings account. So they're really making gifts out of their discretionary income. And there's a lot of competition for discretionary income. Not just charitable gifts, but it's your mortgage, your grocery bill, going out to eat, or entertainment, clothes, various other things, other charities who are asking for gifts from the same pool that is really a small portion of what most people own. Meanwhile, if we consider all of the other types of property that we or others own, that opens up whole new worlds of opportunity in terms of what we can do for the community and for our favorite charities with charitable gifts. Okay, so what are some of these options for gifts other than cash? The most common types would be appreciated stock or appreciated mutual fund shares. Now, when I say appreciated, I don't just mean that I'm glad that I have them or that I'm grateful for them. I mean that they've increased in value since I acquired them. So they've grown, not dropped in value, or they haven't declined. Closely held or privately held business interests, there's a few different types listed there. We won't go through that alphabet soup, but there are different forms of business ownership. Most of them can be used in some way for a charitable gift with the right tools and vehicles. Life insurance policies, those could be gifts either of a life insurance policy during life if it has a cash value, or it could be the death benefit with a beneficiary designation on the life insurance policy after the donor passes away. Real estate can be used in many ways for charitable gifts, and I know community giving knows this better than most, and having been really on the forefront of this trend in establishing the Minnesota Real Estate Foundation years ago, that's a place that can accept these types of gifts. So that might be a primary home or a secondary home, a cabin or vacation property. It could be undeveloped land. It could be farmland that you've inherited from your family and don't necessarily want to keep. In some cases, commercial real estate can be used for charitable gifts, as well as oil and mineral rights. So those are all different options. Tangible personal property. That's the stuff that you own. So basically, everything that you own that you can touch that isn't real estate is one way to think of it. And so this could be either something that might be helpful to the mission of an organization, equipment or supplies or something they use routinely as part of their work. or it could be something that they as the charity would accept and then turn around and sell for cash, and then use that cash for the mission. That could be artwork or musical instruments, jewelry, vehicles, etc. Intellectual property rights. Some people have copyright or patent or royalty interests that have value that can be used for charitable gifts as well. Also, don't forget about farms, not just the farmland, but inventory, livestock, and crops. And there's a technique using something called a flip crut that I don't think we're going into detail on today, but we could talk about some later time, that can be used to turn those things into a stream of income for retirement or for a loved one. Digital assets are a newer category that we didn't really have to consider 10, 15 years ago. But with the rise of cryptocurrency and non-fungible tokens or NFTs, charities are now accepting gifts of those assets as well. The last two here, IRA qualified charitable distributions or QCDs, and grants from donor-advised funds. Technically, they come in the form of cash, but I list them here as non-cash assets because they come from accounts or sources that aren't typically a checking or savings account. So once we've considered all those different options and what other than cash might we be able to give, let's take a look at why it's valuable and helpful to make gifts of appreciated stock and other appreciated long-term capital gain property. As a precursor to that, we'll do a little bit of a primer to say, okay, what are capital gains taxes? Some of you know this already, but for those who don't, capital gain is tax on the realized increase in capital gain property, for example, stock or mutual fund shares, from the sale or disposition price and the cost basis. And so cost basis is either if you acquired the property during your lifetime, if you bought it, what you paid for it, what it cost you to acquire. If you received it from someone else, then it could be either something called carryover basis or stepped up basis. And we'll talk about the differences between that in a second. But the capital gains tax, let's say you've got a share of stock that you paid $20 a share for. Now it's worth $100 a share. There's $80 of unrealized capital gain there. So if you sold that stock or otherwise disposed of it, there could be $80 of capital gain that's realized, and then you would have to pay capital gains tax on that. So what's the tax? The tax varies depending on what your income is. So the higher your income, the higher the capital gains tax rate, and typically it's 15 or 20%. There's also a 0% capital gains tax rate, but most people it would be 15% to 20%. But if you are above a certain income level, then the net investment income tax kicks in an additional 3.8%. So it actually could be 15%, 18.8%, or 23.8% would be that with actual capital gains tax rate. But let's say you're in that 15% capital gains tax rate, and you sold that share of stock for $80. Then you sold it for $100, leaving you with $80 of capital gain. Then you would pay 15% of that $80 as your capital gains tax. Okay. Now I mentioned that how you acquire a property matters. So if you got the property rather than buying it yourself, if you received it as a gift from someone else, if it was a gift given during life, then we use something called carryover basis. So in that example of the share of stock that I bought for $20 is now worth $100, if I gave that to my son while I'm living, then he takes my original basis in it. So his basis is $20. If he sells it for $100, he has $80 of capital gain that he has to pay capital gains tax on. In contrast, if I die and leave that same share of stock to my son through my will or another mechanism, then he would get what's called a stepped up basis. He would get a step up in basis at death. So it's the the value as of the date of death is the new basis. So in that scenario, the $100 share, the new basis is now $100. If he turns around and sells it for $100, there's zero capital gain. So just something to be aware of with respect to capital gains taxes. Okay, now that we've had just a brief overview of capital gains taxes, let's see how that works in terms of a charitable gift using that kind of asset. So in this example, we've got a donor, we'll call her Mary, who is looking to make a really wonderful, generous gift to her favorite charities, and maybe she's doing that through a donor-advised fund at Community Giving. So here she's got $1 million in cash or $1 million in appreciated stock that she can use for this purpose. And this $1 million of appreciated stock, she originally got it for $200,000, and so there's $800,000 of unrealized long-term capital gain. She's trying to decide whether she should use the stock or the cash to make the gift. Which of those should she choose? Well, you all know, because you were here just a couple minutes ago, that she should use the stock to make the gift, but let's take a look at why. So let's say that she decided to sell the stock and use the proceeds to make the charitable gift. Now, I have a real life example of this happening. It wasn't with $1 million gift, but it was with a six-figure gift where the donor instructed her broker to sell the stock, and then called up our charity and talked to one of my colleagues and said, the broker sold the stock. I've got the cash just waiting there, ready to go to fund my fund when we're ready with the fund agreement. And so this does happen, where Mary sells the stock and then gives the $1 million in cash to Community Giving. Community Giving says, "Thank you so much. That's really wonderful," and sets up her donor advised fund. But then the next spring, her accountant calls and says, "Hey, Mary, remember that $1 million of stock you sold last fall? The tax bill for that is $190,400. So Mary has to pay that out of her remaining cash. She's left with $809,600, just shy of $810,000. Now, let's say instead Mary had attended this webinar, or had maybe talked to somebody who had attended the webinar, and they said, "Well, wait a minute. Instead of selling the stock and giving the proceeds, why don't we instead give the stock directly to charity and do it that way?" So Mary calls her broker, and rather than telling him to sell the stock, she says, "Why don't you give that to Community Giving instead?" So the broker does that, and then Community Giving sells it. But because Community Giving is a tax-exempt organization, it doesn't have to pay the capital gains tax on that stock gift, or the stock sale rather. And so Mary, next spring, when her accountant's doing her taxes, there's no tax that had to be paid because Mary didn't sell the stock. She's left with her full $1 million. So if you take a look at this, there's absolutely no difference to charity. Charity gets the same amount either way. But which of these do you think Mary would prefer? Which of these makes a difference for Mary? And so, by the way, whether it's Mary having an extra $190,000 in her pocket, that's one option, or Mary could have had a bigger impact for the same tax cost. So she could have given that additional $190,000 to Community Giving instead of Uncle Sam, and she would have the same amount of cash. So either way, usually, almost always, it would be preferable to give the appreciated stock to charity in that scenario. Okay, now that we've talked about why it's a good idea to use gifts of appreciated assets to make charitable gifts, let's take a look at what things might look like for the rest of this year and 2026 and beyond. One of the things I'm going to talk about here is a concept called bunching charitable deductions. You may be very familiar with that term, or this may be the first time that you're hearing that term. So we're going to walk through what that means and what it looks like. So what is it, and why would people do it? Well, bunching really means combining multiple years of charitable gifts into one tax year, so you itemize in that year. If in a normal year you would have itemized deductions that are below the standard deduction level. And this is a way to get some tax value, get some tax savings from those charitable gifts where you otherwise would not. Because remember, if you're taking the standard deduction, generally you're not getting tax benefit from those charitable gifts, or unless it's capital gains tax savings, that could be one way, or with this new limited non-itemizer deduction starting in 2026, that could be another way. Or if you're making an IRA qualified charitable distribution, that could be another way. But generally speaking, if you're taking the standard deduction, that you're not getting much tax benefit from most of your charitable giving to organizations. Looking ahead to 2026, the standard deduction next year looks like it's going to be $32,200. So if your total combined itemized deductions are lower than that, normally you're going to be taking that standard deduction. So the goal here with bunching is to make enough charitable gifts that you would go above the standard deduction or go above that $32,200 with all of your itemized deductions combined, and then take that itemized deduction in that year, and then the rest of the years just take the standard deduction. So beginning next year, as we noted, only contributions above that 0.5% of AGI are deductible. So just to be aware of that again, and a couple of tips related to this. You may be thinking, well, if I do all of my giving this year, what do I do in the other years? And from an operating charity's perspective, they may be a little bit nervous if they get a big gift from a donor in one year, but then no gifts from that donor for several years after that. So a donor advised fund is one way to manage that timing issue, where you can make a gift to the donor advised fund in the year that you're bunching, and then decide later how you're going to spread out those grant distributions in the non-bunching or in the standard deduction years. So I think that's going to be a really popular technique, even more so than it already is. So ever since 2017 and the doubling of the exemption back then, bunching has been a popular technique and hot topic. Now I see that only becoming more so going forward in 2026 and even probably 2025 actually. It's important to coordinate this with your other deductions, and so that could include mortgage interest, SALT, which is the state and local taxes, including property taxes, state sales taxes, et cetera. And to determine how much you're going to save, you would just basically multiply that total itemized deductions by your marginal tax rate. So if you're in the 32% bracket, it's whatever your deduction is, times 0.32, and that would be roughly your tax savings. So this is an illustration that will show here. I'm just going to spread the window a little bit. Maybe it doesn't make a difference on your screen, it does on mine. Okay, to show what it looks like if you just spread out gifts equally over 3 years, 2026, 2027, and 2028, or if you took advantage of this bunching technique and accelerated the later years gifts into year one. So here, the assumptions are that you would give equal amounts of $16,500 each year to charity, and the deductible portion of that in 2026 is going to be $15,000. Why? Remember that 0.5% of AGI floor, and here if the donors have a $300,000 AGI, that means the first $1,500 of their charitable gifts are disregarded, or that they're not able to deduct the first $1,500. So at the end of the day, at the end of the year, they've got $15,000 of deductible charitable gifts, and let's assume they've got $15,000 in other itemizable deductions. So $30,000 total itemizable deductions, and that's the case in each of those 3 years. Well, that's still below the standard deduction. I don't know what the standard deduction is going to be in 27 or 28, so I just left them even or assumed that they're the same as in 26. But in each of those years, they're just a hair under that standard deduction, so it makes the most sense for them tax-wise to take that standard deduction, and they're really not getting a lot of tax benefit from those charitable gifts. Now, let's say instead they're talking with one of their advisors or a gift officer, or they attended this session and they heard about this idea of bunching, And so if they have the resources to do it, to accelerate all 3 years that they otherwise would have spread out from 2026 to 2028, do that all in 2026. So they do that 16,500 per year, which times 3 is 49.5, I believe. So 49,500 of charitable gifts, but remember it's being reduced by that 1,500 for that AGI floor. So basically 48,000 of those charitable gifts in that first year would be deductible. So 48,000, you're already over the standard deduction, but then add that to your 15,000 and other itemizable deductions, and you get up to 63,000. So in year one, rather than taking that standard deduction of 32,200, you get to take a $63,000 itemized deduction. And then, of course, you are below that standard deduction in future years if you're not making other large charitable gifts, but that's fine because you still get to take the same standard deduction you would have taken anyway. So this is a really powerful way to be able to get some good tax benefit from charitable giving when you otherwise might not be able to. And then, as a reminder, what do we do with that? This is just the same information, just showing the numbers a little bit more clearly. Giving that 63,000, you could give those to individual charities and tell them, look, I'm making three years of gifts all at once, so don't expect anything in 2027 or 2028. Or you could give it to a donor advised fund and then request that grants be made out to your favorite charities in year 2 and year 3 from the DAF. Here is that same scenario, but in a chart that I put together, and that hopefully would show the actual or potential tax benefit of that. So this is comparing spreading out the gifts over the 3-year period versus bunching them into year 1 under the One Big Beautiful Bill Act. So the assumptions we're making here is that it's a couple married filing jointly, they've got 300,000 of AGI, that they're in this marginal tax rate of 32% combined, federal and state, so maybe 24% federal, 8% state if they're in Minnesota, roughly, and that we're starting to make these gifts in tax year 2026. The standard deduction in that year is $32,200, and that they're contemplating making this $49,500 of charitable gifts either spread out over 3 years in the first scenario or all in the first year in the second scenario. And that they're limited by this new AGI floor that reduces the amount that they can deduct each year by $1,500 each year, and that they've got $15,000 in other itemizable deductions. Now, when I was reviewing this earlier, I noticed an imperfection in my example. It's not a fatal imperfection. Like all the math here is still should work just fine. But it's something that makes this a slightly less likely scenario than I otherwise would like. It's still a feasible scenario, but it relies on some further assumption. And that I don't know if anybody would notice this, but I want to point it out and explain it in case somebody's looking at it later and is scratching their head. And that has to do with the fact that I made their AGI $300,000. And maybe in future illustrations, I'll make that a slightly smaller AGI. The reason being, if they're a couple that has AGI of $300,000 and they live in a state like Minnesota that has income tax, it's likely that they're going to have more than $15,000 in other itemizable deductions. So I just want to point that out. Maybe for purposes of the integrity of this illustration, assume also that they've got other tax credits or other below the line deductions that get their itemizable deductions down to $15,000. So that's just a caveat for this. But in this scenario here, if they spread out those charitable deductions and made those charitable gifts so they be able to deduct $15,000 of charitable gifts and $15,000 of other itemized deductions, that's $30,000 total. In each of those years, that's under the standard deduction. But note that under the new law, they also get the benefit if they're making cash gifts of this new non-itemizer deduction. So this was a deduction that didn't exist previously. But $1,000 per person or $2,000 per couple, that below the line additional deduction for non-itemizers. Only for non-itemizers, people were taking the standard deduction. That's an additional benefit that they didn't get before. So the total deductions for them in that scenario would be $34,200 in each year, or if you multiply that by 3, $102,600. Now, if you assume that 32% marginal income tax rate combined, then the tax savings there would be about $32,800 from those standard deductions plus the special non-itemizer charitable deduction. Now, in contrast, let's say instead they bunched their $49,500 of charitable gifts in year 1. Again, they have to reduce that by $1,500 because of that AGI limitation. So they can deduct $48,000, add that to the other $15,000 of itemized deductions. So their total deductions in year 1 is $63,000. And versus the standard deduction, well, 63 is the clear winner. Because they're itemizing, they're not eligible to take that special non-itemizer deduction. So their deduction for that year is $63,000. In the subsequent years, they're not making further charitable gifts because they bunched it all into year 1. So their total deductions are $15,000, well below that $32,000 standard threshold. So they take the standard deduction. I do note here, if they wanted to get some added tax benefit and make some smaller gifts in year 2 and year 3, they could take advantage of this $2,000 non-itemizer deduction by making these $2,000 gifts directly to charity, and then they would have even more deduction. But in this scenario, that would not be consistent with what we're saying they're doing elsewhere. So it's $32,000 for each of those years, or a grand total of $127,400. If you multiply that by their marginal rate of federal and state combined, that's $40,768. So that $40,768 minus the tax savings under the old scenario means that they would have nearly $8,000 in actual tax savings. So that's pretty significant. I mean, most families could do quite a bit with that extra $8,000 and go on some trips. You could pay for education. You could do a variety of things, maybe do some more retirement savings, but it's meaningful. So they're still making the same total amount of charitable gifts. They're just getting more benefit from it. So that's something that I wanted to share. I will pause to see if there are any questions about this, because I know it's a lot of numbers and moving pieces, but just wanted to see if anybody had anything they'd like clarified about that at this point.
I don't see any questions in the chat at this point,
Okay.
Joe. I
we'll
do
move
have
on.
some questions, but we'll get to that when we
Okay.
get to the Q&A.
Great. And we're getting close to that anyway. Okay, so then just a couple of observations about this bunching technique. So one thing that I noticed in going through this exercise of actually running these numbers in different scenarios is that this 0.5% AGI floor, or penalty, depending on how you want to look at it, for itemized charitable gifts makes this bunching technique even more effective and more attractive than before. And why is that? Well, if we go back to this chart here, you'll notice that that reduction happens only in year 1. It's only in the year that you're itemizing the deductions, versus having to have that reduction every single year, because it's tied to your AGI. It's not tied to the amount of the charitable gift. So it's 0.5% of $300,000 in this case, or $1,500. So every year that the itemizable portion is reduced by $1,500. Well, if you're only itemizing in 1 year, you only have that reduction in 1 year, and the other years you can take advantage, if you want, by making additional smaller gifts and using that non-itemizer deduction for even more benefit. So for that reason, because you're basically only getting 1 year of that loss of deduction, you get the additional benefit of those other years that you would have had to reduce it by. So that's one point. And then in contrast, I think that special non-itemizer charitable deduction can provide some people with a little bit of a disincentive, or reduces the effectiveness or attractiveness of this bunching, because that's a benefit you only get if you take the standard deduction and you don't itemize. So that, that's a little bit of a negative, but it's still in many cases, most cases, bunching is going to put you far ahead. I will note that sometimes the deduction limitations, so as we noted, it's 60% of AGI if you're making cash gifts, or 30% of AGI if you're using appreciated stock or other long-term capital gain property, that can come into play depending on what the donor's AGI is. So if they have a relatively high AGI, they probably can take all of the deduction in that first year. But if they have a lower AGI and they're making these large bunching gifts, they may not be able to use all of that in year one. They may bump up against that AGI limitation, but that's okay, because you can carry forward the unused deduction to later years, up to 5 subsequent tax years, if you need to do that. And you can mix and match these options to maximize the tax savings. So as I was saying, bunch those gifts into a single year, carry over any unused deductions if you need to. You can make these smaller gifts in your standard deduction years to take advantage of that special non-itemizer deduction. And then just consider what your tax rates are going to be for each year, so that if you think you're going to have a particularly high income year, you may want to target that year to be your bunching year to reduce taxes and get the greatest amount of tax savings when you're going to have a higher marginal income tax rate. And maybe taking the standard deduction in years where you expect to have a lower income. Then we'll turn to donor advised funds. As we mentioned, that this can be a really valuable tool, particularly in combination with that bunching. This is a little bit of background about what a donor advised fund is and how it works. I know this is old news for many of you, but for some people it may be new, that a donor makes an irrevocable gift to a donor advised fund at a sponsoring public charity. So one very common example of this, and the original donor advised fund sponsors are community foundations like Community Giving. I think I had heard that the first donor advised fund, and Steve or someone else can correct me if I'm wrong on this, was I think in maybe 1931, but it was 1991 when I think Fidelity Charitable got into the game. So for about 60 years, community foundations were the only organizations that really had these donor advised funds. Well, now you can also open them at the nonprofit subsidiaries of many investment firms, and some operating charities also have started their own donor advised funds. But you make the contribution to the donor advised fund, but then you would receive an immediate income tax deduction for that contribution. To note that you wouldn't receive additional deductions when the donor advised fund later makes grants out to other nonprofit organizations, because that would be double dipping. But you do retain the right to advise on these distributions. So you don't legally control it. The DAF sponsor is a legal owner of it at that point, but you have the right to advise or make requests about how those grants are made and where and how much. Most of the time, with some limited exceptions, the fund sponsor is going to make those grants in line with your requests, unless there's some reason that they really can't or really don't want to. They really can't if you're asking them to make a grant to an organization who is not a valid recipient of a charitable gift. If it's a for-profit, or if it doesn't qualify for those distributions. Or in some cases, for a fund sponsor that may have certain principles, whether religious or ethical principles of their organization, and you request a gift to an organization that they think is not in line with those values, then they may also decline to make that grant. But most of the time, the grants that are requested are made as the donor advisor had indicated. So as we said a couple times, this can be useful for bunching donations. This diagram on the right is from my friend and also my accountant, Kyle Wesley of Wesley and Wesley, that shows a few of these features with the donor transferring the appreciated assets. They get a tax deduction for the fair market value of the assets. They would then advise on charitable grants. The donor advised fund would take those assets and invest them in a certain way, and then the DAF administrator would approve grants made from those DAF assets to operating charities. Donor advised funds have grown dramatically in popularity and in size over the years. So there's some data I found from the National Philanthropic Trust and their 2024 DAF report. They had numbers that were current as of 2023. I suspect they'll have the 2025 report out soon that would show what it looks like for 2024. I would hope, or maybe they're not doing it every year. But in the 2024 report, they showed 251 billion in donor advised fund assets, about 54.77 billion in grants from DAFs, and about 1.78 million total donor advised funds accounts, a little over 100,000 of which were held at community foundations. And I want to point something out, because sometimes donor advised funds get criticism because there is a view out there that many donors are using them as essentially a parking lot where they'll stuff money into it and then not make charitable contributions out of it, or not request that grants be made out of it. And in some cases that may be true. There may be some donors who are using them that way. But by and large, the numbers don't bear that out at all as a perception. Most donor advised funds are paying out a significantly higher portion of their assets each year than, say, private foundations. So private foundations have a 5% minimum payout rate. Well, for whether you consider it fortunate or unfortunate or whatever, that tends to be where most private foundations pay out, is at that 5%. So for many of them, it ends up being more of a ceiling than the floor, even though it is a floor. It tends to be both. So private foundations, on average, might pay out around 8% of their overall assets. Compare that with DAFs, where they pay out about 24% of their total assets. So the community foundations and other DAF sponsors are doing, I think, a pretty good job of keeping that money flowing and getting those dollars into the community where they're going to do positive good. Okay, just wanted to do a little bit of a commercial here for community giving. They didn't ask me to, but I wanted to note that they do have donor advised funds and a mechanism for doing that. You can find it easily on their website, and also more information about what their donor advised funds look like, how they operate, and who to contact if you want to know more about them. Some final notes about what should we be thinking about toward the end of this year in 2025 and then beyond. Well, for this year in 2025, I think, as we hinted at before, or even said briefly earlier, that if you have a donor who is contemplating a major gift to any charity, they should really consider whether they might want to do that in 2025 to increase their tax savings. And this would certainly do that by avoiding that 0.5% AGI floor, but also if they're in that 37% tax bracket, the second bullet point says that they'll have additional tax savings that they will lose if they wait until 2026 or later. And if they're doing that, a DAF is a vehicle that they could use for both of those things. Also, similarly, corporate donors will be subject to that 1% AGI floor next year, whereas they aren't in 2025. And so to consider if they're going to be making gifts to get more advantage out of that by making those in an accelerated way in 2025. So looking forward to next year and beyond, I do think that bunching is going to be a more valuable giving technique, and even more so than it has been for the last 8 years or so. That actually it's probably been closer to 10, that donor advised funds can be a very helpful tool for accepting those bunched gifts and then advising on where you want those grants to go to your favorite charities afterward. Take advantage of that $1,000 to $2,000 special non-itemizer deduction for those years where you're going to be taking the standard deduction. And then again, it may have a negative effect on those smaller level annual corporate gifts. That if they're not getting a tax break for it, they may be less likely to be making those contributions. But they could bunch a whole bunch of them in a single year and make it more worthwhile that way. Okay. That is the end of my prepared remarks. So with that, I would, I guess, ask Dominic if anybody has any questions that they would like to go over.
Well, Joe, first of all, thank you very much. You said at the beginning you hoped that we would take one thing away. I have taken a bunch of things away. I have taken copious notes. Again, if you do want to ask a question, we ask you to use the Q&A function at the bottom of your Zoom screen. We have a few minutes for a couple of questions. I have a couple, and I think, Joe, probably my biggest takeaway is the idea of bunching when combined with the donor advised fund is an extremely powerful tool, and it benefits both the donor and it benefits the nonprofit organization that they want to support that has an assurance of gifts on a consistent basis. So that feels like a gigantic value proposition for community foundations and other folks who offer donor advised funds. And that seems big. Can you think of other, like, as we are, as community foundation folks who are always striving to make it the best possible value proposition for the folks that we deal with as we work with them to help communities, what else would you articulate as particular advantages of working with a community foundation in these times?
Sure. So I think that's a good question. Well, one way that I think that community foundations like yours can be really helpful is in partnering with charities that might not have the same resources, expertise, maybe risk tolerance. So maybe they're talking with a donor who's contemplating a gift that could be a great gift, but that charity is not in a position where they'd be able to administer it or even accept it, depending on what the asset is or how it's intended to be held. So I think those are additional advantages of just being an option for maybe accepting a type of gift that maybe under the charity's gift acceptance policy they're not able to accept, or that feels too risky for them, whether that's real estate or it could be privately held stock. Or it could be cryptocurrency, could be a number of things, and so I think that's a real advantage. And then also on a longer term basis, maybe a donor wants to make a gift to fund an endowment, and a lot of charities will manage their own endowed funds, which is great, but maybe they don't have the bandwidth, or maybe some other organizations don't have the bandwidth or the expertise in-house to be able to handle that, and so they could, I would assume, partner with someone like you to set up that endowment that ultimately would be for the benefit of the charity that the donor wanted to support in the first place.
Sure. Yeah,
so those are a few different ways, I think.
Yeah, and your reminder of community foundations' ability to work with non-cash assets, I don't think can be stated enough. And I think the numbers that you've stated in terms of like what we have for liquid cash as opposed to other assets, that was a real eye opener for me as well. If you had a client coming in saying, I am just trying to make heads or tails of all the things that are going on, what would be the first couple questions that you would have them sort of interrogate for themselves as they are thinking about what they want their charitable legacy to be?
So when you say a client, are you saying like an individual or couple?
Sure, yeah.
Yeah. So I think they need to take a step back and decide what's most important to them. And I like to approach this from a values perspective, what values have been most important to them during their life, and then also a story perspective. So what's been the story of their life? What's been the story of their families? And how do they want to continue that story or that legacy after they're gone? So there's a question that I have a colleague who likes to use, and I think it's a pretty smart way of thinking about this. And that question is to ask somebody, if you had a large sum of money, however you want to define that. So it's going to be different for different people, but if you had a large sum of money, whether it's $100,000 or $1 million or $10 million or $1 billion, if you had some large sum of money that you were asked to give away, and there are only two stipulations: you can't spend it on yourself, and you have to get rid of it right now, what would you do? What would you do with it? And so to maybe think about like that exercise. What would I do with that? Would I decide to give 75% to my kids in equal shares and 25% to state and local governments? I think if most people were asked that question, that probably wouldn't come to mind. They might think, I want to do something for my family, but maybe thinking about specific things like helping buy a home or start a business or make sure that they're provided for X number of years. But then there's probably other things that they might want to do for their community, whether it's a church or a synagogue, mosque, a social services charity, arts charity, whatever, that they may have needs that they've maybe wanted to help with, but didn't feel like they had the resources to do. So when they sit down and think about like, what would I want to do with that large sum of money if I had to give it away right now and I couldn't spend it on myself, the answer to that question is probably their estate plan. And then it's just a matter of figuring out how do we get there. That's sort of an unconventional way of looking at it. But I really like to ask people to think about what they're trying to accomplish. What is it that you actually want to do for your family? And what's a smart way to do that? And then to the extent that there's anything left, what would you like to do with that? And those can be fun conversations.
Sure, absolutely. I think that's a great answer. We have a great question from one of the webinar participants. On a practical level, how should one use a donor-advised fund to fulfill a multi-year campaign pledge without violating the limitation, but satisfy the charity that the commitment will be fulfilled?
Okay, so historically, donor-advised funds have not been able to be used to satisfy a campaign pledge. That was just a no-no, as part of the rules that you can't get any quid pro quo or any benefit. I think that there's maybe a little bit of analysis that would go in to say, is this a legally binding pledge or enforceable pledge? So are you actually satisfying a legal obligation, or is this just something that they said they were going to do but isn't legally binding? So, but I think a lot of DAF sponsors don't want to try to figure out in each case whether that level of nuance, and so we just say we're not going to pay pledges out of it. Well, there's that guidance that came out, I think 2017, that provided some other rules that basically gave the thumbs up or made it okay to satisfy a pledge from a DAF as long as certain things were satisfied. And I think one of those things was that you didn't mention the pledge. And you all know those rules much better than I do. So I might defer to someone at Community Giving to answer that specific question. But my understanding is that the pledge could be satisfied, I think, as long as there was no specific reference to it in the documentation. But I could be wrong about that. That's just my limited knowledge of that, and I would ask if there's somebody else from Community Giving who knows more that they could chime in.
And Sarah has popped her camera on, so I'm assuming she's got some contribution to make here.
Actually, Sarah didn't have any contribution to make.
Okay, all right. You're just waiting for your.
I would confirm for Joe that is correct, as long as you don't refer to the pledge, and we just carry forward a granting strategy to do that, then that is allowable.
I know that is. I know that that's an issue that a lot of nonprofit organizations are dealing with, especially as they go into campaigns. I have one more question for you, Joe, before I ask Sarah to bring us home. Lots has changed in the last year. All of our crystal balls are cracked. But if I asked you to look at what the next year or 2 or 3 or 4 is going to look like, do you see the next from a philanthropic perspective? Do you see that this is going to be sort of a static period, or do you see more changes, and what those changes are going to look like? Who knows?
Yeah, I have a feeling that we're probably not going to. Well, and this is pure speculation, so please take that with a grain of salt. And I don't know any more than anybody else does about what's going to happen. But I would say that I'm thinking that we're probably going to be living in the world of OB3 or the One Big Beautiful Bill Act and those new rules for a while now. I don't see that changing dramatically, at least in the next 2 years, but probably for a while beyond that. Maybe down the road, who knows? We'll see some changes on those things. But I do think that a lot of what we'll say in the way of charitable giving will have to do with what the markets do. I mean, there's just a strong correlation between major giving and what the stock market does over time. And so if we stay in these great market times, then I think we'll continue to see really strong charitable giving. If markets drop significantly or other things happen with the economy, I think it's a different story, and we're probably going to see a drop. That said, I think that maybe what we've been talking about here with bunching is still going to be relevant because even fewer people will have, if they're making smaller gifts, it'll be less years or fewer years when they'll be itemizing, and so bunching is a way to take advantage of those gifts that may be bunching over a longer period of years or whatever their situation might suggest. So I think that's one prediction. Also, I think some of these new things that this is really interesting. I heard a lobbyist talk about this, who was in the weeds with some of this OB3 legislation, talk about this summer, where they said once these levers and these dials become part of the law, then it makes it easier for Congress to tweak those dials, to turn it up or to turn it down. So, we've seen this 0.5% AGI floor. Well, now that didn't exist before, but now that it does exist, it's not too far-fetched to imagine that being cranked up to 1% or 1.5% or whatever. So, I mean, I think that's something we could see happening down the road too, but my crystal ball is fairly cloudy, so I don't count on that.
As are all of ours. Joe, we are so grateful for your wisdom and your context. It strikes me that I did not introduce myself at the beginning of this session. My name is Dominic Papatola. I'm the Chief Impact Officer for Community Giving, and I have the tremendous pleasure and privilege of working with a gigantic number of very smart, very caring people, one of whom I'm going to introduce as Sarah Carlson, who is going to bring us to our conclusion.
Thank you, Dominic. And thank you to Joe. That was illuminating and a lot of information, but really well presented. And special thanks to all of you for hanging in there with us while Zoom was giving us a run for our money today. I want to thank everyone for the work that you have been doing. Whether you are a donor listening to this, you are a colleague, a peer in the field, or you are a professional advisor that is sending these kinds of questions into the hands of your local community foundation staff and others. That work is really important right now, and there are certainly many needs that charitable resources will be necessary for in our community. So I want to thank you for all of that. I also want to encourage you to reach out to one of our team members. All of my colleagues who lead community foundation work in a specific geography are on the screen for you. And we are nothing but a phone call and an email away. So there is no silly question to ask us. If we don't know the answer, we will find someone like Joe who can advise us, or one of our house counsel that can assist. So please do reach out if there's a way that the community foundation in your respective community can be of assistance. We are here to help. There will be a recording available of this, along with other professional advisor resources and past webinars. That recording will come out to you directly, but you'll see on the screen in front of you where you can find professional advisor resources and past archived recordings. You can also visit our Planned Giving website there at plannedgiving.communitygiving.org. And if you have an idea for content, a speaker, or you yourself would like to be featured and showcase something that you know, we would love to hear that. So please do email us at info@communitygiving.org with that information. Our next topic coming up for a webinar will be a reprisal of a webinar that we have done several times that we've been reached out to and asked if we would bring back. So our ED team will be presenting something on December 4th from noon to 1:30 in the afternoon about working with your community foundation and special tips and things about year-end giving. So we will be sending you additional information about that and how you can register sometime very soon. Again, thank you for making time to spend part of your afternoon with us and for everything that you are doing to make your communities wonderful places to live, work, raise a family, and do business. With that, we thank you and wish you well.